All right, so welcome back to our next video, and this video we're going to put together the Greeks. So that's ultimately my goal for you, is to really understand and look at the bigger picture of how the Greeks really operate within your position and kind of within your portfolio as well, but more or less within the position. So when we look at the position itself, you have to take all the Greeks into account. You know, a lot of people, they understand the price. They understand the time, but they don't understand the Vega. Some people don't understand the gamma when their gamma is high. So for us, what we're going to do is we're going to break apart kind of the construction of it and really look at all the factors. And then in one of the next videos, we'll take a look at setting up a neutral position, because you have to understand how they all work in the components. And as you move one level or the other, you know, it affects the other things. So ultimately, that's what I'm going to try to do in this video, is explain it to you in maybe one or two different ways, and then see if you kind of get it. So let's start out with our bigger picture concept and get things going. I want to start a little bit from the beginning. And just to get things going, remember, our full calculation of the value of the option is going to be looking at price plus time plus volatility equals money. The formula is really more complicated than that. I'm trying to keep it simple. For you, hey, is the price going up or down? That's one big thing to watch. That's going to be your delta and your gamma. The time, are you in a positive theta state or a negative theta state? And the Vega, are you in a positive Vega or a negative Vega position? And then what's happening to the Vega? So that ultimately changes your position. So as we go back and start reevaluating some of these things, let me go ahead and show you a couple of these review concepts. So here, let's start out with, we're going to go ahead and look at, let's go back and check out the options decay speed. This is ultimately the huge part behind our options money-making strategy and system, is that options decay. And because options decay, you know, when you're a buyer, they decay like this. For us, since we're a seller most of the time, we're going to be making that money in the opposite way. So we make a little bit a day, a little bit, and then it starts to pick up the speed. So that speed starts to pick up fairly quickly and rapidly as that decay happens. If we look at our delta is our, looking at the delta is the stock ultimately going up or down. So it's the 1 point change. Let's go here. Delta. When we look at the delta, this is telling us our price risk. So in this case, if we have a delta of 10, that means that we need, just in price terms, we need stock prices to go up to make money from the delta. Okay, if we have a delta of negative 14, then we need price to go down just to make money from the delta. So all of these are kind of your worker bees. Let's go to the gamma, and we can actually keep it on the same page. The gamma, let's go this way, gamma is your speed or rate of change of the delta. So let's say you've got a delta of 10, but a gamma of 3. Well, what does that mean for your next delta? Well, 10 plus 3 is going to be 13. Here again, delta of, let's say, negative 15 and a gamma of, let's say, 5. We're just keeping it simple for now. Let's say the stock moved. Well, what's going to happen? Well, your next delta is going to be negative 10. Okay, well, it could also be negative 20, because we're adding 5 one way or the other, depending on the movement of the curvature. So ultimately, the gamma is just your change in delta. And if your gamma is really fast, then your delta is going to be shifting and whipping around quite a lot. Now, time, we've already covered. So if we go back to our pricings here, the calculation, we've covered price, we've covered time. time is just the rapid decay. And if we look at Vega, this is probably the most confusing thing for a lot of people. And I'm going to bring this chart back for you. So here, let's get rid of this paper and get rid of this paper so we have some clean sheets. Okay, and volatility is really, every option has its own VIX or volatility in a way. And with the SPY, it's the VIX. With the RUT is the RVX. Remember, this gets a little confusing, and it's because the VIX, as the VIX is heading higher, volatility is increasing. As the VIX is heading lower, volatility is decreasing. Most people get that part. Now, as the VIX heads higher, what does that mean for stocks? Stocks actually go down. Okay, so as the VIX heads higher, stocks go down. As the VIX heads lower, okay, stocks actually increase. So here, stocks go down. So this is bad for stocks when the VIX goes up. Think of the VIX as insurance. People getting panicked, if you want to think of it that way. Otherwise, a down VIX is good for stocks. If you're like a long-term investor, boom, that's good for stocks. So it works opposite. So as the VIX goes up, stocks go down. As the VIX goes down, stocks go up. So that's how it works. It's opposite. If this helps you, remember this. If this helps you visually, remember that. But ultimately, if this helps you as well, then use it that way. In either case, VIX high or low is relative. Sometimes a high VIX is 22. Other times, a high VIX might be 50. So different market conditions have a different high VIX. Same thing with the low. Sometimes you might see a low of 16, a low of 20, and a low of 9. So sometimes you have your range of 10 to 14, and sometimes 14 is high and 10 is kind of low. So anyways, that's some of the stuff that you should kind of know and understand and grasp from kind of the basics that we've covered. And of course, review some of the other videos to get an even better handle. Now, what I want to do now is get into understanding all of this together as a whole. Because what a lot of people do is they look and focus on each one of these individually, but they don't look at it as a whole big picture. And that seems to be the problem. So I want you to think of, I'm going to do this as one example, as kind of like a video game in a way. But ultimately, let's say we have these three kind of pens or pencils. And if I start pushing on one, it affects the other few, right? If I push on the other, it affects the other few. And that's what happens. If price moves, well, it's going to affect your volatility. It's going to affect your theta. It's going to affect a lot of things because you're in a different area of the curve. If I push it this way, they all move and they start changing. So that's one example. Okay, so I'm going to give you a couple different examples. So they're all interconnected. So we'll cover a couple examples here. So let's check these out. Our first example is the pens. If this works for you, great. My second example for you is we're going to look at player assignment. So if you like video games, or if you've played video games, or if you play even golf, you'll kind of get this concept. So let's say you have a character that you want to create in a video game. So here, video game character. And you have 20 points that you can allocate towards different things. So we'll call this the video game avatar example. So in this case, we're going to go ahead and you have different abilities. Characters, what can a character do? Run, jump. Let's say they can have a fireball or spit something. So how strong is that? And run, jump, let's say strength. And you have these kind of 4 characteristics. So I'm getting into this. You might be wondering, why am I showing you these different examples? I'm trying to show you that everything is interconnected. That's my big goal here, is this is connected together. Okay. What I'm showing you here with this video game avatar is that all of these are going to be connected together. And in our case, our connection is our delta, or in other words, our price plus time plus volatility is all connected into our money. Okay, so this is delta and gamma. This is our theta, and this is our vega. So that's what I'm trying to show you. So if you had 20 points to allocate to a video game character, well, you have a few different options. Let's say somebody might say, hey, well, I want a really, really, really fast character. Well, I got 10 points for him, but I only got 20 that I can use. Well, then I might only say, well, I got to sacrifice it on the jump. He can't jump as high, so I'll put 2 there. I'll put maybe another 3 for a fireball. I want a fireball, so let's say here. And then the strength is the rest. So I got 10 plus 5, that's 15, and I got 5 for strength. So there's my character. So where's my power? My power is in the running space. Okay, let's say I got another character. Well, let's say this guy, his main thing, I want him to be strong. So I put a 7 here. Maybe I put, let's go with also a 3 on the fireball. Maybe I do another one with, now I'm up to 10. I do jumping. I want to go 7 here. So I got a guy that can jump really high. I got a guy that's pretty strong. So that's 17. And then I got 3 left. So my big issue with this one is that, hey, he's slow, but he can jump and he's really strong. This guy, he can run, but he's overall average. Or of course, what you could do is put a balance on everything. So let's just do one last one right here. And I could say, okay, well, he's a balance, 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 balance. Now, which one is better? Well, it depends. Do you need to run? Do you need to have strength and jump? Or do you want a balance of everything? So if we look at all of this as a delta, gamma, theta, vega, well, what's more important to you, right? So that's what I'm trying to get to for you to understand, is that they all work together. And if I'm looking at our big formula in terms of how everything is set up, well, here's kind of the interesting part. Let's get into it right here. So if I got price plus time, or theta, plus volatility, okay, and there's our money, obviously. Okay, so here, let's say in example number 1, okay, and let me draw this out like this. I'll try to make it a little more even for you. Let's see here. We'll go like this. Okay, so now if I look at the different versions of it, okay, let's say I go ahead and use green for one variation of a diagonal. Well, let's say that has a really, really high price or high delta. The theta is kind of weak, and the vega or volatility is kind of high. So that's kind of one version. Let's go to another one. Let's say another one has a very light delta. Another one has a really good time and kind of so-so volatility. Okay, so there's your other variation. Let's go to a different version. Okay, well, maybe we've got kind of a medium price, medium time, and a medium volatility. So they're all different types of trades. Now, if I move one, the others are affected. So you have to look at which worker does the most work. And here's my take for you. You have employees. This is what this business is about. There's different employees. I'm going to go ahead and call this, and bear with me with all these examples. I'm just trying to make sure you really understand this concept. So let's say price will name Peter. Time we'll call Tom. And volatility we'll call it Vicky. Okay? So if I got Peter, Tom, and Vicky in my business, okay, and they all get paid let's just say the same. Okay, if they all get $10 an hour and they all show up to work for the same amount of time and they work just as hard, well, if they get $10, $10, $10, well, all of a sudden, let's just say if I'm making $10 from the work Peter does, $10 from Tom, let's say we sell, toothpaste, and for the amount of toothpaste tubes they make, they bring the business X amount of dollars. So it's $10, $10, $10 per hour, or just $10 for the day. So in this case, I make $30 from them as a business owner. Now, let's say we go to another version where Peter is, making 40. Tom is making still 10, and Vicky's making 13. Well, who's my biggest worker? Who's my superstar? Well, in this case, my biggest one that I need to focus on is make sure Peter's happy. My worst worker is kind of Tom. He's not really bringing in a lot of cash for me. So what happens is Peter needs to show up, which means Price. Price has to do some work for me. It's my biggest Greek. If Price doesn't show up to work, or if he doesn't come to work today, I'm screwed, because all of a sudden I'm losing money. I'm not making enough. But if in this case, if it does work out, I'm making $40, $50, $63. So my point here is that if your best worker, the one that shows up, is actually doing great work, it can be in your favor. If he doesn't show up, because he's normally the best worker, if he doesn't show up to work and now all of a sudden that's not good for me as a business owner, well, I'm losing money on him. So I'm losing $40. Now in that case, how long does it take for Tom and Vicky to make that up? Well, Tom's got to work 4 times if he did it individually, so he's got to work a lot harder, and Vicky about 3.5 times. So together, between both of these, well, they got to work about twice as hard to make up just what Peter's doing. So that's kind of the issue. And you could look at it in another way. Let's say we go to, let's say Peter is kind of a slacker, which means in this case, ultimately what we're doing is doing a diagonal that's very price heavy. Okay. Let's say we do it something, whereas here it's a little more, let's say, balanced, or more like a calendar in a way. Here, what's going on is, let's say we turn Peter into a 7. Let's say Tom is 28. And let's say Vicky is, let's just make it a little bit more normal, like we might see, 96. So what's my biggest, my smallest is 7, so I don't have to worry about price too much. But my biggest one is actually Vicky, which is volatility. Now, in this case, what am I making? Well, let's see. I didn't make the numbers so easily or so simple, but here we got about, let's see, 7 plus 28. This is, let's pause it real quick and I'll do the math for you. All right, so I got 131. Now, my biggest Greek is 96. Now that's Vicky, the volatility. And because of this right here, how long does it take if I have volatility going in my favor? It's fine. But if I have it going against me, let's say she does not show up to work. Let's say it's going against me. I'm losing $96. Well, how long does it take for Tom to make it up? It's about 3 times. So it's a 3 times difference. Let's say we did something more like a 15, let's go 20, and let's say 390. Now, look at that spread. Sometimes the volatility, or Vicky, is way higher. So how many days? If you had a 1% volatility problem, how many times difference? What's the range of this? Is it 5? Way larger. Is it 10? Now you're getting into 200. Is it 20? Yeah, it's almost like 20 times larger. So that means it takes 20 days for Tom to do the work if you got a Vicky problem. So my point here for you to look at this is to understand the risks, is that they all work together. You might make some money on price. You might make some money on volatility, but who's coming into work and where are you making the most money? Sometimes you're making the most money on volatility, or here in our case, volatility right here. This is the biggest one. This one would be the first one. Other times you're making the most money on, let's say maybe time right here. Here's the orange one. So this one has time making the most money. So different trades will have different advantages, but with that have different disadvantages. Like this example, price is your biggest one. In this example, volatility is your biggest worker. So you need to understand, how do you balance these kinds of things? So what I could do is go ahead and manipulate some of these things, and I'll share that with you right now. And we'll get into it here in kind of the next video, because I think this video is already long enough. I just wanted to get you to understand the relationships behind these, the different price, the theta, and the Vega, and do a quick little review. Next, what I want to do is share the relationship of it on screen so you get a better grasp and understanding of how they all work together. So let's check it out on the trading panel and platform, and then you'll get a better insight to it as well.